welcome back to my channel, guys. So on today's video I'm gonna make it real quick. I want to talk about the investment, the basic investment concepts. I want to talk about it right now before I can be able to travel, so we're gonna make it real quick. Okay, so you need to know these basic investment concepts before you can think of investing. Even if you started investing, I think you should just go back and just learn what these concepts are, because they're really important when you are someone who invests in the stock market, in the real estate, just anyway, you know. So the first one is risk and return. That is the first basic concept you have to know about investment. So risk and return, they're like this, ne? They go hand in hand. So the more you risk your money, the more you will get more returns. But the less risk that you take, the less returns you will take. It's the same thing as going into a relationship, you understand? You take a risk to love that someone, and you hoping that someone genuinely loves you back as much as you love them. So you're taking a risk. So it's the same as investment. When you think about investments, just know that you're just gonna risk your money. It's not just that. It's not like savings where you can say, you know what, I'm gonna put my savings, my money in the bank, and I know I'm gonna get it the same next year, or even 2 years or 5 years time. So investment is all about risk. So the more risk you take, the more returns you get. But the less risk you take, the less returns you take. But just make sure that you always have to take the risk that you can handle. So just know your risk tolerance, and you'll be good to go. So the second concept is the risk diversification. Risk diversification, it simply means that you are distributing your money to different assets. I think I talked about this back in my previous videos, but let me explain it again. So you are putting your money in different assets because you're trying to make your risk lower than when you put your money in one asset. You understand? You're not entirely taking out the risk, but you are reducing it. So make sure that you distribute your money in different assets, which can be stocks, where you buy shares in particular, like different companies, or you can put it in bonds, or you can put it in buy gold, buy all these different assets. There's just so many assets that you can put your money in and distribute it, even if it's not equally, but just make sure that you don't put your money in one asset, because that's a risk. You're taking a high risk. So you distributing it is reducing your risk of losing a lot of money. All right, so the third concept is dollar cost averaging. So dollar cost averaging simply means that you taking the fixed amount of money every month, and you're gonna put it in that particular company, and they'll in return give you shares. So in easy equities, they call it recurring investment. So you set up that recurring investment, so each and every month they will keep on taking money from your account and buying new shares. So dollar cost averaging simply helps you to be able to buy more shares, because if you take 10,000 rands, right? If you take 10,000 rands and then put it all at once and buy Capitec shares all at once, that will give you that particular, maybe I don't know how much Capitec is, maybe it will give you 10 shares of Capitec shares, right? And then if you paid like every month, but not just like putting it all the money all at once, it's gonna give you more shares than buying it once off. So dollar cost averaging gives you more shares than buying a once off. So dollar cost averaging is the same as recurring investments. So those two are similar concepts. All right, so the fourth concept that you need to know about is compound interest. So compound interest is interest on interest. You get interest on the same interest that you had before. So the longer you put your money on that investment, the more you will benefit from compound interest. It's interest on interest. So if you got interest this year, you get more interest next year, which will be interest on the interest that you got from this year. You understand? So it keeps on. It's compound. If you get interest next year, it will be interest that will be on the interest that you got from this year. So you understand, it's interest on interest. That's what compound interest is. If you don't really understand what I'm talking about, please go to Google and research what compound interest is. It's really beneficial if you are someone who wants to put your money away for a long time. Okay, the fifth concept that I wanted to talk about is inflation. So when you are investing in the stock market, make sure that your return rate it's always beating the inflation. So inflation in South Africa keeps on going real quick. So make sure that each and every time you do your investments, your return rate is always it beats the inflation or it matches inflation. So make sure that happens, guys. If you don't understand what inflation is, you can go back to my previous video or just go to Google and see what that means. So yes, guys, that's what I wanted to talk about, the 5 basic concepts of investment. So I hope that you learned something from this video, because that's what I'm always aiming at. Thank you for watching. I will see you on my next video. Bye.